This is the current federal tax developments for the week of October the 27th, 2025. Current federal tax developments are brought to you by your State Society of CPAs. I'm Ed Zollers from Phoenix, and I'm recording this a bit later than normal because I was catching up on putting together a number of sessions I'll be working this week, as well as for conferences coming up. So, have a few things, but late on a Sunday, but still here, we got it going. I'm going to talk about what we're going to be looking at this week in terms of developments. And key, we're going to start with, we're going to reevaluate the DC-QIE exception under FIRPTA. Again, more regulations being rethought by the new administration. We'll have technical revisions to Revenue Procedure 2025-32, relatively minor, but there was a very quietly introduced revised version of the inflation numbers for next year. We'll talk about transitional reporting, shall I say, for the qualified passenger vehicle loan interest deduction for this year. This is the first simplified reporting method of those items that we're getting this year that are deductible under Section 63 in computing taxable income. Those are the ones probably people are a little more interested in, looking at the tips and the overtime, especially how employers are supposed to try to handle that. But you take what you can get at this point. We'll talk about TEFRA, readjustment petitions. And this is a question about the jurisdictional clarity. And that is equitable tolling available for this one? That seems to become a big issue recently following the Batchelor case. We're seeing more and more of these issues arising for equitable tolling, even though for TEFRA, it's obviously only have a short-term interest because we're now out of the TEFRA partnership years and into the BBA years. But again, we'll have to see how this goes. Probably more interesting for the general idea of whether the courts will decide that Batchelor opened the floodgates for basically everything going to the tax court, or whether there are ones that they didn't open it up for. We'll talk about a case with S-Corp income attribution and substantiation problems for a taxpayer. And again, this is another one of those cases where a taxpayer believes that for practical purposes, their S-Corp share ownership is, kind of worthless. The other owner controls everything. Problem is that almost never allows you to ignore flowing the income through to your return. We'll talk about some clarifications on what's going to be operating at the IRS during the lapse and appropriations. We'll also talk about some clarifications the IRS made to employee retention tax credit compliance following the changes made by the One Big Beautiful Bill Act, and also some clarifications from 1099-K information reporting updates, again due to One Big Beautiful Bill Act changes. Let's talk about reevaluating the DC-QIE exception under FIRPTA, Proposed Reg Section 1.871-1, Regulation 109742-25. This proposed reg was issued on October the 21st, right? So essentially, under FIRPTA's mandate on 897, gain or loss is recognized by a foreign person on the disposition of a United States real property interest is treated as an effectively connected income. Now, this USRPI, U.S. Real Property Interest, includes interest in U.S. real estate projects and interest in any domestic corporation that qualifies as a United States Real Property Holding Corporation, a USRPHC. Now, domestic controlled qualified investment entities, which is the DC-QIE that we're talking about here, they have an exception. An interest in a DC-QIE is generally not treated as a U.S. real property interest. So a qualified investment entity, REIT or RIC, that is or would be a U.S. real property holding company is domestically controlled if less than 50% of the value of the stock is held directly or indirectly by foreign persons during the statutory testing period. That's the background we're looking at here. Now, what happened was in 2024, final regulations were approved, Treasury Decision 9992, that adopted a domestic corporation look-through rule. And under this rule, certain non-publicly traded domestic C corporations were treated as look-through persons if the foreign persons held more than 50% in the corporation's stock. And the rationale for the withdrawal, because there were complaints about this, that there was significant feedback cited practical difficulties, specifically the challenge of tracing upstream ownership and the lack of reliable data in many cases, saying that this was just not going to be workable. The taxpayers also argued that these rules conflicted with statutory intent, noting that Congress provided look-through treatment in limited cases under 897 H4E, and that suggests the general omission in 897 H4B was intentional by Congress, not an oversight. Now, the proposed regulations will simply remove the domestic corporation look-through rules that were in Treasury Regulation 1.897-1C3. Under the new framework, all domestic C corporations will be treated as non-look-through persons for this purpose, for this testing. So consequently, when a domestic C corporation, which is not a foreign person, holds QIE stock, that corporation is treated as a United States person for determining the QIE's foreign ownership percentage. We're not going to look through into that corporation to try to figure out how, if there is a majority foreign ownership in it. And there is both a reliance and effective date in these regulations. The regulations, as quite often is true with regulations like this, provide that taxpayers may rely on the proposed regulations immediately. They also may choose to apply the final regulations retroactively when they come out to transactions occurring on or after April 25th, 2024. So essentially, that's the plan. Again, this is another one. We've seen a few of these come through that are backing off things. The IRS very quietly on October the 17th issued some revisions to Revenue Procedure 2025-32. And they didn't really post anything anywhere, except that they posted a revised version of the revenue procedure on their website, where you go and you look for, the interesting IRS-drop website, or directory, really, that has it. So what the revised guidance was, which was issued on October 17th, it modified the original October 9th issuance version we talked about last week. These revisions incorporate some necessary corrections and detail some amendments made by the One Big Beautiful Bill Act. So again, they're inflation adjustments for the 2026 year. And there are not a lot of these that were modified, but you do need to be aware there are some. They added the addition of the Section 42 Amendment. A new Section 2.05 was added to detail an OBBBA amendment to Section 42H3I related to the low-income housing credit. And this change increases the calculation amount used to determine the state housing credit ceiling for that credit. So the consequence is, though otherwise all subsequent OBBB or OB3, whatever you want to call them, amendments previously listed were renumbered. So what you're going to find now is, for example, the AMT exception for Section 55D4 that was originally numbered Section 2.06 in the first version is now 2.07. Minor detail, but if you're looking, saying, wait, that citation's wrong. No, it was right when the thing was first issued, just wrong now. So the low-income housing credit ceiling, the revised guidance provides significantly higher figures for calculating the 2026 ceiling in Section 4.08. The amount is a greater of $3,416 multiplied by the state population, essentially, or not $3,400, $3.41.6, I should say. That's up from $3.05 previously. There were some minor upward adjustments made in the completed phase-out amount for 3+ children to $70,244. It was up from $70,224. Obviously, a typo there, right? You put 2 2s there instead of 2 4s. So we ended up with bringing that back together. That one makes some sense. And the real catch is, if you're looking for inflation-adjusted numbers and you downloaded that first PDF during that time period it was available, you probably should go back and download the revised version. If you go to the link we have in our story when we wrote about this, that link goes to the place where they kept both. So what you'll find is you would get the newer one there on the website if you went to that site. We had IRS Notice 2025-57 issued on the 21st of October, and this is going to give transitional reporting for the qualified passenger vehicle loan interest deduction that takes effect on 25 returns. Remember, a deduction of up to $10,000 for interest paid on a car, essentially you bought in 25, that meets the qualifications of being built, domestically built, and has a few other rules in play for what works and what doesn't. So, this provision amended Section 163H4 to temporarily exclude qualified passenger vehicle loan interest, QPVLI, we have an acronym for everything, from the definition of personal interest. This allows for deduction of QPVLI for taxable years beginning after December 1st, 2024, and before January 1st of 29. So basically 25 through 28. And a qualified personal vehicle loan must be incurred after December 31st, 2024 for the purchase of and secured by a first lien on an applicable passenger vehicle for personal use. Now, there was a reporting mandate added at new section 6050AA that mandated information reporting for anybody who's in the business of making these loans. If you made a payment, if somebody has paid you interest, that would qualify for the QPVLI deduction. So recipients engaged in that trade or business had to file a return if they received interest that totaled $600 or more from an individual on a specified passenger vehicle loan on a qualified vehicle. Right? The return contents are detailed and extensive. They include an outstanding principal, the loan date, the vehicle and the vehicle identification number. This year, you're not going to be required to file that form. You merely can have, and there's some examples in the actual notice, a written pay statement containing this detailed information is going to be furnished to individuals by January 31st of the following year. Okay. So this transitional relief acknowledged that recipients need time to update their systems, following the fact that, the OB3 was passed in the middle of this year. So for 2025, you can satisfy the OB3 requirements under new 6050AA through a simplified means. This says recipient must only make a statement available to the individual by January 31st, 2026, indicating the total amount of interest received on the specified passenger vehicle loan in 2025. And recipients that adhere to this transitional reporting will not face penalty under 6722 information returns or 6721, I should say, information returns to the IRS, or 6722, the payee statements to the recipient. So you're not going to get some sort of variant of 1098 this year. You'd have to just check the loan statement to see if they tell you that this would be a deductible interest amount. Again, we're looking at whether or not we can get equitable relief. This one involves TEFRA readjustment positions. This is a reported tax court decision that came out this week. It's a tax court decision 165 TC number 9, the case of Northwall Holdings LLC, Schuler Investments LLC, a partner of the Tax Matters partner, and the partner in question trying to file for a TEFRA readjustment petition versus the Commissioner of Internal Revenue. Now, the key question here was whether the statutory deadline for filing a petition for readjustment of partnership items under the repealed TEFRA regimes are jurisdictional limitations or mere processing rules. This is Batchelor Goes Another Place. We're going again to see whether the Batchelor case, which was dealing with a collection due process situation, which, by the way, as I find amusing, is when Batchelor went back to court, the court finally decided that she didn't qualify for equitable relief, so her late petition was simply late and tough luck. But nevertheless, she had the right to argue that she could qualify for it. Now, normally under TEFRA, the Tax Matters partner, our old, equivalent of the partnership representative, now we're kind of the similar thing to the current partnership representative under BBA, had 90 days after the final notice of partnership adjustment, FPAA, the final FPAA mailing to them to file their tax court petition. That was their 90 days. Now, if they don't take action, notice partners, generally those have more than 1% interest in the partnership with certain limitations, have 60 days following the close of the TMP's 90-day period to, basically file and decide to defend the partnership on their own. That gives you 150 days from the mailing. Now, in this case, the taxpayer, Schuler, filed 18 days late, 168 days after the FPAA was mailed. They argue the deadline should be subject to equitable tolling, going back to Supreme Court's decision in Batchelor. Now, the tax court, which is always, the tax court still keeps insisting that all of this is jurisdictional until such time as somebody overrules them. Not surprisingly, they held the petition deadlines In old IHC-IRC section 6226, I'll get that right, A and B under TEFRA are jurisdictional provisions. You come in late, tough luck, the tax court's not allowed to hear your case. Now, they said section 6226F explicitly grants jurisdiction to a court only if the petition is filed in accordance with this section, which includes timing requirements. And they also said the coordination of the TEFRA petition deadlines ensures that only one partnership level proceeding occurs. And they noted that historically, but pre-Batchelor, the Fifth and Ninth Circuits, among others, have consistently treated these deadlines as jurisdictional. You can't argue, well, I had a good reason for being late, won't get you anywhere. That's a tax court petition. Now, the court found even if the deadlines were non-jurisdictional, any presumption in favor of equitable tolling was rebutted. They said they looked at congressional intent. The TEFRA scheme is highly detailed and includes explicit targeted exceptions for premature petitions or partners who did not receive proper notice. The essence of these targeted exceptions demonstrates Congress did not intend open-ended equitable relief, but they gave statutory relief, right, for any exceptions outside of the dates in question. They also noted that there is a bit of an administrative incongruence, I love the term, that they have. Allowing equitable tolling would create serious administrative problems that are fundamentally incongruent with the statutory schemes. The problem is the IRS operates under very narrow timing here, right? An untimely petition disrupts the basically lifting of the assessment restrictions and conflicts with the commissioner's ability to initiate their computational adjustments. Generally, since TEFRA proceedings affect potentially thousands of partners, and that is usually the IRS has 1 year after the dust has settled, the court decision is final. If you're not going to file in tax court, that makes basically the FPAA final. They have 1 year from that date to essentially assess the tax on all the partners. And since these proceedings affect thousands of partners, allowing one partner's equitable tolling could benefit all partners, and that would get around the statutory rules. Because remember, if you litigate this, you're one of the notice partners, you decide to litigate the question, then you're going to defend it for everybody. You're taking on the tax matters partner's position effectively in the litigation scheme because they didn't pick up the ball and run with it, so you're going to. And as I said, the problem there is, you could have somebody coming in late, so the IRS would spend all that time, send all those notices out, and then somebody sees what the actual number will be for them, and now they decide to raise the ruckus and try to argue equitable tolling. And they said, look, that's just unworkable under this system. So the IRS's motion to dismiss for lack of jurisdiction was granted because the petition was untimely. We'll see if this gets appealed. As I said, probably not the big issue here is not whether or not a court of appeals, what they do to TEFRA proceedings, because we're running out of those. Although we still see a number of them finalizing up things in the court like this one. But rather the idea of some of the other questions for jurisdictional, is essentially the deficiency petition deadline, which is the big fight right now. Is that jurisdictional or not? And this could give a leaning as to how if the states, or if I should say, if the courts of appeal are simply going to say everything gets equitable tolling, or if it's going to be restricted in some way, shape, or form. Next up, falling out among father and son. This is an S corporation income attribution and substantiation of deduction failures. This is the case of Barry v. Commissioner, Tax Memorandum Decision 2025-109, and issued on October the 21st. Now, the tax court sustained an $88,695 deficiency and a $17,739 action-related penalty under 6662A for the 2016 tax year. And the key issues that arose and was being challenged by the taxpayer was Andrew Barry, right, the son, a 50% beneficial shareholder of the S Corporation, PCR, for the full year. And did PCR underreport substantial income from diverted client payments, cash receipts, and unexplained bank deposits? Now, the commissioner satisfied the Ninth Circuit's Weimer-Skirch burden by linking the taxpayer to the income-producing activity. saying we're good. Now, the tax court excluded several key taxpayer exhibits due to violating the 14-day standing pretrial order rule, late production. Late production prejudiced the IRS, particularly as the review showed inconsistencies and alterations in those documents. Not only were they springing upon the IRS late, but they really appeared to be questionable, right? As far as shareholder status, the court confirmed that Andrew Berry was a 50% shareholder for the entire year. Andrew and his father apparently had a bit of a falling out. Andrew was removed as a corporate officer, but the court note merely being removed as a corporate officer doesn't equate to your loss of beneficial stock ownership. And to show that even though on paper it was your stock, it really wasn't, that requires very strong proof to establish a transfer of beneficial ownership that would stand up in state law courts, something the taxpayer didn't do. Merely saying, well, my dad did this and he's freezing me out. You're still going to pick, as corporation income flows out. Remember, distributions are still going to be pro rata. He may never make one because he's mad at you, but you got to pick it up. That's one of the problems with S corps. Now, there were a number of unreported income items involved. The bank deposits of $59,000. The taxpayers claimed that $58,000 was a bona fide loan repayment of that was. The court sustained the income determination. Loan documents were excluded, and the loan lacked any standard terms, even if you paid attention to them, interest or repayment schedule. And further, the alleged loan was not put on the corporation's balance sheet on 1120S. If it's a real loan, why wasn't it there? Right? How about the $74,082 of diverted receipts? Various payments for services the corporation were diverted to pay for the father's motorhome. That was sustained as income at the corporation under the assignment of income doctrine under Helverling versus Horst. That regardless of whether the father considered a loan from the S corporation or not was irrelevant. It was services performed by PCR for a customer of PCR, and the fact that Dad said, "Oh, give me that check," and we're just going to go ahead and do it this way and not report it. Yeah, it doesn't work well. And the court also disallowed the son's claimed whipsaw defense. He said, well, wait, you shouldn't tax me on it. My dad already paid tax on all this stuff. And the court said, number of potential problems there with the whipsaw argument. But the biggest one for you, Mr. Taxpayer, son, is you failed to show that income had already been taxed to the father, Roland Berry, and, Roland and his wife. Therefore, couldn't cover that. For the accuracy-related penalty standard, the IRS met the burden of production by showing the proper written supervisory approval under 6751B1. The taxpayers failed to dispute the penalty or assert the affirmative defense of reasonable cause. So basically, negligence and record-keeping problems. The court specifically noted the negligence includes the failure to keep adequate books or records under Section 6662C, and therefore the court felt the accuracy-related penalty was sustained. It was based alternatively on the petitioner's negligence and then separately on resulting substantial understatement. Didn't matter which way you went for it, 20% penalty applied. Now, the IRS issued some clarifications on what operations will basically continue and not continue. This was a post on the IRS website that they say will be updated to have any future developments. Been titled Statement on IRS Operations Limited during the Lapse in Appropriations. The regular tax deadlines remain. Again, on the IRS website, the update was made on October the 21st. Now, compliance obligations and payment processing will continue. As the IRS notes, the tax law remains in effect, despite the fact that the funding has lapsed, the government shutdown, all tax law remains fully effective. So all the payment deadlines still matter. That means all the tax deadlines for individuals, corporations, partnerships, and employers remain in effect. Filing and payment must continue as normal. And the IRS continues to accept and process all payments and remittances received, whether electronically or by mail. There are, however, some service limitations you need to be aware of. During the shutdown, all the IRS Taxpayer Assistance Centers are closed, and all pre-scheduled appointments, including appeals and taxpayer advocate service, are canceled during that period. Live telephone customer support is limited. you are encouraged, tax professionals, to direct your clients to use irs.gov to obtain information. Sign up for an IRS personal account. You'll be able to see what the transcripts say. We're going to have very limited options, although they still answer the phones to a certain extent. I was able to get through on a penalty abatement issue. So things like that, but not general things, right? And generally, refunds are being delayed. There is an exception. Refunds will continue to be paid for Form 1040 filers if the returns are electronically filed, error-free, automatically processed by the system, not kicked out for something, and are designated for direct deposit. If you clear all those, that means if you paper file, you're not getting your refund until everybody comes back, and then probably long after that. If they find an error on the return, then it's not going to be paid. If for some reason they can't process it automatically with what they have, it won't be paid. And if you didn't designate direct deposit, it will not be paid basically until the shutdown ends, apparently. Now, automated tools and enforcement activities, the automated applications remain operational, including irs.gov, online payment agreements, Where is My Refund, and the Income Verification Express service that mortgage companies and the like use. Correspondence backlog is going to get bad. While mail is being received, the IRS is not responding to paper correspondence. A significant backlog should be anticipated upon reopening. Now, I always want to warn tax pros about this. Don't take this as an excuse. Remember, we started with all deadlines remain. If you need to make a response, remember, you're going to have trouble getting through on phone lines potentially. If you're hitting a deadline for a response, go ahead and send in the paper. Certified mail, basically, you don't need to worry about return receipt because somebody's going to be there to stamp it. But you do need to get the white piece of paper stamped by the Post Service employee. That will help serve as a proof that you timely filed this thing. Yes, the IRS may lose it. Yes, you may be arguing forever, but you've got a way better legal standing than if you're there saying, well, I just didn't call because you guys wouldn't answer the phone. I couldn't get a hold of you. That's not likely going to work, right? That's going to be the problem. Compliance work necessary to protect statutes of limitations will continue, but a lot of other enforcement will slow down or stop. Work conducted by CID will continue, so Criminal Investigation Division, throughout the period. And they're not going to be processing application for tax-exempt status or pension plans. Any of those sorts of requests for rulings there are simply not being processed during this time period. So trade-off, what's there, what's not. Okay, let's talk about employee retention credit compliance under the OB3 rules. The IRS updated the frequently asked questions that talk about employee retention credits under the ERC compliance provisions of the One Big Beautiful Bill. This is basically, fact statement or, 2025-07, FS 2025-07 on October the 22nd, 2025. Now, the OB3 introduced some stringent compliance methods, notably Section 7503D, which limits the allowance and refund of certain ERC claims. The deadline bar was the big thing. Section 7605D of the Act, OB3, prevents the IRS from allowing or refunding ERC claims pertaining to third and fourth quarter of 2021 claims if those claims were filed subsequent to January 31st of 24. This bar applied after July 4th of 25. Now, what is the definition of file? A return claiming the ERC is treated as filed on or before January 31st, 2024, only if the claim was postmarked and properly mailed or submitted to the appropriate IRS office by that date. So first rule, do you have a certified mail? White receipt is what we're looking for here. For the most part, if the IRS says you didn't meet the deadline, that shows a date on or before January 31st of 2024 for your submission of your claim for refund. Now, if an affected quarter 3, quarter 4, 2021 claim was filed after that date, was already refunded or credited before July 4th of this year, then Section 7605D generally does not apply to that claim. So you can keep the money if you got it before July 4th or the claim was paid before that date. Section 70605D does not apply to amended returns filed after the deadline if their purpose is solely to withdraw previously claimed ERC. So if you filed before January 31st, but you now want to withdraw your claim, you can still file those. They clarify that. Now, the procedures and your appeals in this case, if your claim is disallowed pursuant to 7605D, the taxpayer will be issued letter 105C, claim disallowed. Appeals right in this case, you maintain appeals right to the IRS Office of Independent Appeals. However, appeals is typically limited to cases where a taxpayer believes the claim was in fact timely filed on or before January 31st of 2024. And the IRS has misplaced the provision. If you're just coming in to argue, oh, this is unfair, it's like go talk to Congress. It's not our deal. Congress tells them, we're not going to pay you. We can't pay you. Sorry. Talk to your congressperson. Taxpayers relying reasonably and good faith on these FAQs, which is FS 2025-07 current version, may be shielded from accessory penalties to the extent such reliance results in an underpayment. Unlikely, but possible. Finally, another FAQ update. This one on the 1099-K information reporting changes made by OB3. This one's entitled Fact Sheet 2025-08. Issued here in October updates, and they revise and update Form 1099-K frequently asked questions. And you'll see the questions marked with an update date behind them. This is how you know with ones that have been changed, in essence, what the new questions and answers are. Okay. Now, this was, as you may remember, OB3 told us to go back and totally ignore the ARPA change, American Rescue Plan Act change, that was going to have 1099-Ks issued at much lower thresholds. We're going back to the pre-ARPA threshold for third-party settlement organizations. And they must file 1099-K only if the pay receives gross payments exceeding $20,000 and the number of transactions exceed 200. Right? Payment card exceptions, payments received via payment card transactions, credit or debit stored value cards, do not have a threshold, and those 1099-Ks must be issued even for 1 cent payment from card transactions. So this is in essence the third-party settlement organizations, the Ubers, and that sort of things, Ubers, eBays, those sorts of things, not payment cards, right? Credit cards, etc. Now, the compliance and taxpayer identification number issues, third-party settlement organizations must request a payee's Social Security number, I-10 EIN, if payments are expected to receive the 20,200 transaction threshold. And failure to provide a correct TIN can trigger backup withholding when they're required to report under 3406A. The coordination rule in question 11, if a transaction is reportable on 1099-K and potentially also on 1099 miscellaneous or 1099 NEC, it must be reported only on the form 1099-K. Dual reporting is prohibited. So they're making that clear. Some people were confused saying, well, this looks like it should be reported on NEC, but it also should be on a K. They're saying if you have to file the K, don't file the NEC for the same payment. Now, you made some payments that are third-party settlement organizations and some that were just other types of non-employee compensation, then you would issue both for each type. The 1099 NEC for those payments that were not required by the 1099-K would be your other issues, right? Reporting personal sales at a loss, questions 6 and 7 in the FAQ. For erroneous forms 1099-K or forms reporting non-business personal items sold to loss, report the gross 1099-K amount positive and the offsetting amount negative in the entry space at the top of Schedule 1, Form 1040. I've been told that before. How about bifurcated sales? This is question 4. If a single 1099-K reports proceeds where some items result in a gain, in other words, a loss, the gain portion must be reported on Form 8949 and Schedule D. And the loss portion will generally be non-deductible. You report the gross proceeds related to the loss in the entry space top of Schedule 1, Form 1040. That's your issue. As far as gross payment calculation and tax liability, Form 1099-K Box 1A reports the gross payment amount. The gross does not account for basis, fees, credits, refunds, shippings, or discount. Now, quite often, the paying organization will tell you those amounts they took out of the payment, but they really don't have to, and so you need to have accounted for those separately. You must use the Form 1099-K alongside your own records to compute and deduct these items to accurately determine your taxable income. And receipt of Form 1099-K does not mean the entire amount is taxable. nor does the lack of a 1099-K imply the income is non-taxable. All income is taxable regardless of whether or not you had a 1099-K issued, unless it is subject to a specific exclusion from inclusion in income. Right? You know how many clients you've heard over the years? Oh, well, I got paid $500 for this side gig, but because it was below 600, I don't have to report it since I didn't 1099. It's like, you got to report it, right? It's still required to be reported. And you told me about it, which is kind of a bad thing, right? I know about it. I'm signing your return. This is going to have to go on the return. That's the way that works. Yeah, some things, if you're going to cheat, don't tell your tax preparer, I guess is the hint there. This has been the current federal tax developments for October the 27th, 2025. Again, as always, you can email me, edzollers@currentfederaltaxdevelopments.com. I'll try to answer you on some questions. I also pay attention to the Connect sites for the Arizona Society, for the Idaho Society, for the New Jersey Society, Illinois Society of CPAs, Minnesota Society of CPAs, and for Washington. So you can keep an eye there. And if I see an issue that I can respond to, I'll try and respond. Otherwise, thank you for paying attention this week. We will see you back next week. It's getting a little hectic because, as I noted, this is a time of year where suddenly I have to do a lot more, coursework, so it becomes a little bit more fun. But I really don't have many travels left, right? I don't really have any travel except travels driving inside the state of Arizona. So it's not going to be as interesting as it is weeks when I have to travel across the country. So we'll see that. Don't do as much of that anymore. So in any event, we will see you here, hopefully see you here next week with more current federal tax developments.